Hello and welcome to the latest edition of Citrus Bites from our offices in Sevenoaks. So the Bank of England have just announced that the bank base rate in the UK is to remain unchanged at 5.25%. That remains the highest level for 16 years. So we've now been at 5.25% since August of 2023. Now, I think for many there'd been some hope that this month would start the decreasing bank base rate cycle for a number of reasons. Not necessarily because the European Central Bank finally started with a reduction in the European Central Bank base rate. Switzerland have reduced the bank base rate actually for the second time in June, second time this year. But the Bank of England decided to remain unchanged. Why, when perhaps there's some slightly more encouraging data? And when I say encouraging, I mean from a potential reduction in bank base rate perspective. Why is it that rates have remained unchanged again? Let's start with the inflation data. So it's been widely publicized that finally CPI has hit that 2% goal that the Bank of England set. So great news. Interestingly, the government obviously announced that their plan is working. A reminder, the Bank of England are a completely independent body. So they're also pleased their plan, importantly, is working to bring that inflation figure down to 2%. Just worth remembering, at the peak, this was 11.1%. So we've been on a journey over the last year to bring this inflation back down and finally get to that 2%. So in theory, great news. In possibility of a rate change today, but as I say, remain unchanged. So why? I've been talking for months and months and months about core inflation, and I refer to it as sticky inflation. And for all of this time, I've been flagging that this is higher than the Bank of England will want to see. And the reason core inflation is important is because it strips out some of the really volatile metrics, which include things like food, energy, tobacco, and the volatility in those prices makes quite a big difference under the inflation data. So when you strip those out, core gives you a much more stable reading as to what's really going on with inflation. And the challenge with core is it's just still higher than really required. So core's running at 3.5% on a 12-month rolling basis to the end of May. Again, as with all these inflation figures, they're not coming down. It's always worth remembering that. Nothing's coming down. They're just going up less quickly. So core is rising at 3.5% on a 12-month rolling. That's down from the previous reading of 3.9%, but that is still high. So we're back to what is it that's driving this core inflation that's causing the problem? And potentially there's a few different things, but I've honed in for a while now on our services inflation. So that's the other line on the graph. And the reason services inflation matters, and I'm going to come on to it just to talk about wages and unemployment and what's driving it, but it's a good indicator of kind of how consumers are also spending. And services inflation is still running hot. So it's still running, as you can see through this line, at 5.7%. Yes, it's down from 5.9, but it is above the consensus forecast for the reporting period. So we're back to this services inflation. What's driving the services inflation? I'm going to come on to that and just, again, talk to you about regular earnings. So regular earnings are important. Why are they important? Well, they tend to give people money in pocket that therefore enables them to go and spend. And it's these average regular earnings that are still producing this challenge. So talk for a while about the peak in employment and the labour shortage. This is something that's been talked about in many industries. I think nearly every industry has talked about a shortage of skilled labour. So average weekly earnings were going up. They were going up rapidly. Why? Well, potentially to try and make sure you can attract and retain talented labour to enable you to perform well as a company. Well, that figure, even on a 12-month rolling, when you look at the last 3 months, the February to April reporting period, that average regular earnings is still running at a 6% increase. What's interesting here is that if you take the latest inflation spot data at 2%, and you then go, well, average regular earnings are increasing at 6%. And by the way, in the public sector, that's even higher at 6.4%. So the figure I've given you is an average. Clearly, actually, there's a net gain in there. So inflation now from a straight CPI perspective is running lower. What does this mean? Well, it means in theory, these pay rises are generating real extra pay. Now, because of that latest spot inflation data, there is a view now that that average regular earnings figure will start to come down. And the other reason that will start to come down is just looking at the unemployment situation. So as I just said before, being driven hard by a shortage of labor, not enough people to fill the jobs that need to be done. And therefore, that's been a really key factor. But unemployment is ticking up. The number of vacancies are coming down. And at some point, this has to impact the pay rises that are being given, because employers, for the first time in ages, will start to find available labor at a slightly perhaps lower cost than they've needed to do in terms of pay awards in order to fill these vacancies. So unemployment ticking up means there's a bigger selection to choose from in terms of labor workforce available. Benefits payments are going up. So all of these dials from an inflation perspective are going in the right direction. And again, from an inflation perspective, I'm not saying that if you're one of those people who's now unemployed, etc., that's a good place to be, talking purely about the inflation impact. The other thing I'll just mention briefly, I think there's been Swiftonomics. There's been a kind of general view about, is Taylor Swift impacting the economy and driving some of this services inflation, which is quite often due to restaurants and hospitality. I've read an awful lot from my perspective personally. I think it's wildly overcooked. Nothing against Liverpool or London. I think Edinburgh, Cardiff, where Taylor Swift's performed, but I don't see it as being a driver of what's going into the inflation data. So there we go. It's amazing how quickly we move on. The vote this time was 7-2 for no change in the Bank of England base rate. We're immediately moving on to August. So the next decision is on the 1st of August. I think in a recent poll by Reuters, there's a slightly higher expectation now, especially when you compare it to over the last week, what was expected for this month's announcement. But there is still a view that we could see the first Bank of England base rate reduction coming for about a year, actually. I think it'll be a year since the increase. That will come in August. The 1st of August is the next meeting. Obviously, I'll update you as soon as we know more. So that's a bit of a background to today's announcement from the Bank of England. One other thing I wanted to cover today, because the thing that strikes me when we talk about 2% from an inflation perspective, and I don't know about you, but when I'm looking around and when I'm seeing bills come in, 2% is way lower than I'm experiencing. And one such area where there just seems an absolute chasm between what's going on with inflation and the reality, as I would call it, is car insurance. And I've had a question in, which is, what is happening with car insurance and why are car insurance premiums? I think most of us, mine came in literally 1 week ago. It's 50% up year on year. So where do we get from 2% or even 4% or 5% if we're talking about kind of some of the inflation statistics over the last few months? How does that resonate with 50%? Where is this coming from? So look, car insurance, I can't confess to be an absolute genius on this one, but having dug into it a bit more, there are a whole number of things that impact car insurance. And these are not just the labor cost, as everyone else has talked about, the labor shortage. There's also a real shortage of parts and parts being imported, no doubt potentially partly because of the movement of goods, obviously, dare I say it, post-COVID, but also in the production of those parts, the labor involved in producing them, the costs have gone up significantly. There's theft of vehicles happening. So a whole load of things has gone into resulting it. And the other area that car insurers are saying is making a big difference is, unfortunately, where people are involved in serious accidents, the cost of long-term care has gone up so significantly. And all of these different component parts, as well as the cost of secondhand vehicles, everything goes in to calculate what's going on with the price of premiums. I think the Association of British Insurers, the ABI, announced that for last year, so 22 to 23 on a 12-month rolling, I think the premiums were up by about 34%. For me, they've gone up again since then. So this is probably why we're seeing these now 50% uplifts. So it's a good question, but that's a brief indication as to why, this 2% is great. But actually, does anyone really feel like they're sort of better off because inflation is slowing at in terms of the rate it's increasing by? And I think that's one of the really big questions. And although there's a view that Bank of England base rate will hopefully come down within the not too distant future, actually that hasn't filtered through to people's mortgage payments, etc. yet. So I think that's the key thing that we need to feel. We need to feel at some point like we're going to actually get some benefit and feel a difference that's being made. So there we are. We'll see what happens on the 1st of August. That's the next update, as I said. That's it for now. Any questions? If there's anything you'd like me to ask a topic economically when I'm recording the next one, please do send the question in. Let me know. Otherwise, that's it for this month. I look forward to seeing you all again very soon. Take care and bye for now.